Good morning. Welcome back to the Junius Maltby channel. Hoped you enjoyed that vintage news broadcast music as we take a look at the market reactions to yesterday's Federal Reserve decision to raise interest rates. As you all know, we did a quick news broadcast yesterday, and I'm sure you saw it elsewhere. 0.25% raising the interest rates, and today we're seeing a little bit more of a dramatic effect across the trading world. And everything from oil to metals to stocks, everything's kind of reflecting and reacting to that decision. We're not going to place a whole lot of time on it today, but we will discuss it just momentarily here before we move on to our main event, the World Gold Council Outlook for 2016. So stick around. I know this is some boring information, but we are going to do a review of the outlook for 2016 from the World Gold Council and a review of 2015. Good article to read through straight from the horse's mouth. But yeah, what is happening? Well, interest rates, obviously they went up and there's a reaction. What's it going to do long term? We shall see. Are they going to drop them back down when things get bad? Did they raise them too late? These are all questions people are asking. The level of comments we received on yesterday's video when the story broke are phenomenal. You guys are right on point, right on par with your diagnosis and your observations. So rather than sit here and even discuss it, go back, look at yesterday's video, and just read through the comments, because a lot of you out there are absolutely on point, like I said just a moment ago, when it comes to what this means, what's happening. Personally, I think they might try to raise them again in the future, but if something happens in the market, they're going to get skittish and they're going to drop them immediately. And this is going to give them that leeway to do so. I gave an analogy yesterday, or an allegory, that this is kind of akin to the Federal Reserve running into a darkened room with a lit candle, and they're using that lit candle to look around to see what's in the room, to see what they can find. And that room happens to be piled high and stacked with kegs of black powder. So they need to be very careful, because their little candle might set the whole thing into an explosive environment, if you know what I mean. All right, let's just move on. Let's go to the World Gold Council review, because this is going to be a long article. Review of 2015 and outlook for 2016. Alastair Hewitt, head of market intelligence for the World Gold Council, said, 2015 has been a fascinating year for the gold market, with strong demand from central banks, Asian markets, and the European bar and coin market. The pro-gold schemes introduced by the Indian government and the further internationalization of the renminbi, alongside the increasing transparency of Chinese gold reserves, will continue to improve the market next year. Gold's role as a portfolio diversifier, a wealth preservation tool, and a tail risk hedge will continue to prevail due to expensive stock valuations and high liquidity risks. Finally, gold's cultural significance endures as we look ahead to 2016. Synopsis: 2015 has been an interesting year in the gold market, but the big question is what will shape the global gold market over the next year. Up until 2012, gold enjoyed a decade-long bull run driven by a combination of factors: strong emerging market growth supporting consumer demand, central banks' gold purchases to diversify reserves, financial innovation making gold easier to buy, and the global financial crisis and its aftermath. The past 3 years have seen a slightly different picture for the gold price, as the U.S. economy began to recover and fears of deceleration in emerging markets contributed to a decline in the price. A better economic performance in the U.S. has made a Federal Reserve rate rise, likely for the first time in 6.5 years. This pushes the dollar higher, and so could be seen to put downward pressure on the price of gold. The dollar price is down 10%. Investor sentiment remains bearish. Average net longs are at their lowest since 2003, and although they have slowed substantially, ETF outflows continue. In our view, though the effect that the anticipated U.S. rate rise has had on gold has already been largely priced in, as the market has been anticipating this increase for almost a year and a half. Whilst the U.S. dollar price is one driver of gold demand, it is not always the most relevant factor for most investors. In fact, our research shows that higher interest rates are not necessarily bad for gold. Physical demand for gold is truly global. More than 90% comes from outside the US, primarily the Asian economies, particularly China and India. In these economies, local price matters most. And in 2015, the non-US dollar gold price has held up, even inching slightly higher. If there is a temporary downward impact of the price of gold due to a US rate rise, then this could well lead to increased demand in price-sensitive markets such as India and China. We have already seen evidence in China via developments with the Shanghai Gold Exchange wanting to have gold traded in yuan, and in India, the Indian export trade expressing an intent to establish a gold exchange. In 2015, we have seen the continuation of a number of trends in the global gold market. Asian markets continue to be strong drivers of gold demand, with both India and China up year on year as of Q3 2015. Global bar and coin demand is more than double its pre-crisis levels, and the strength of bar and coin demand in Europe is now well established, having been non-existent prior to the financial crisis. Recycling is down and mine production has begun to level off. This year, the Indian government has introduced the gold monetization scheme, a gold bond, and a sovereign gold coin in order to monetize the gold stocks held by the Indian people that are estimated to be about 22,000 tons. In China, there have also been dramatic changes this year. The PBOC, the People's Bank of China's announcements on the additions to their gold reserves from June onwards have been a welcome development in transparency. And gold's role in protecting against currency weakness was illustrated perfectly on the 11th and 12th of August this year after the People's Bank of China devalued the yuan. Against this backdrop, the outlook for gold demand in 2016 remains optimistic. Gold continues to play a very effective role as a hedge, as stock valuations in the U.S. and elsewhere remain elevated, as investors have increased their risk exposure in search of returns amid a very low yield environment. While there are some concerns about GDP growth across emerging markets, economic output continues to increase, and so do incomes. This, in turn, strengthens the case for gold as a long-term strategic asset and wealth preservation tool. We are likely to see further developments in the key Asian markets, with the continuing introduction of the pro-gold schemes and potentially a gold exchange in India. Following the launch of the international board by the Shanghai Gold Exchange to open up the Chinese gold market to international investors, SGE's plans to introduce a yuan-denominated gold pricing mechanism to facilitate regional market trading are also likely to take shape in 2016. Well, there you have it. That's some pretty positive news in my opinion for gold. A lot of the points validate some of the things that we've talked about here on the channel over the course of the last year. What does 2016 hold for gold? I think there's a potential that 2016 could shape up to be a very strong year for gold, especially if we see some market weakness and some trepidation on Wall Street. Well, hold on to your hats, everybody. Keep positive. Look down the road and continue to stack your metals and take advantage of the prices that you're seeing today and going forward. Thank you for being part of the Junius Maltby channel. Have a Merry Christmas, Happy Holidays, and Happy New Year as well. It's coming fairly quickly. I'll see you guys on the next one.